Welcome back to the channel. Today, we are looking at a market in extreme divergence. On one side, India stands tall as a global macroeconomic powerhouse, yet a brutal sudden sell-off in domestic technology stocks has just wiped out over 1.3 lakh crore rupees in investor wealth. At the same time, global markets are bracing for impact as a hawkish Federal Reserve pushes the US dollar to new heights, while rising geopolitical tensions in the Strait of Hormuz keep all traders on edge. Let us unpack how these global forces are connecting to reshape your portfolio today. We start with the bedrock of India's macroeconomic story. The Organization for Economic Cooperation and Development, or OECD, has released its latest report confirming that India remains the world's fastest-growing major economy. This fundamental strength was echoed at the G7 summit, where Prime Minister Narendra Modi championed inclusive global growth while unveiling strategic initiatives for cross-border skills and infrastructure connectivity. Despite localized volatility, the underlying structural foundation of India's economy is showing immense long-term resilience, attracting sustained interest from global allocators. However, that long-term optimism faced a severe reality check this week in the public equity markets. The benchmark Sensex and Nifty snapped their impressive 5-day winning streak, dragged down by an absolute bloodbath in the technology sector. The Nifty IT index slumped by a staggering 6%. This massive sell-off was catalyzed by global tech major Accenture cutting its revenue growth guidance, which instantly sparked fears of a prolonged slowdown in enterprise software spending, causing panic among domestic institutional and retail investors alike. Zooming in on individual stock movers, Infosys and Tata Consultancy Services bore the absolute brunt of this tech panic. Infosys shares tumbled over 8%, hitting a fresh 52-week low. Investors rushed for the exits after Accenture's revised forecast highlighted that high interest rates and economic uncertainty are forcing global clients to halt discretionary IT spending. Tata Consultancy Services also saw its stock tumble significantly, proving that even the most defensive market bellwethers are not immune to a global systemic slowdown in enterprise demand. While technology bled, other pockets of the Indian corporate ecosystem showed idiosyncratic strength. In heavy engineering, transformers, rectifiers, India saw its share price surge by 12% today, driven by strong quarterly order books and domestic grid modernization efforts. Meanwhile, defensive heavyweights were in focus for different reasons, as banking giant HDFC Bank turned ex-dividend, drawing significant volume, and small-cap industrial player Master Components Limited saw targeted accumulation ahead of its own dividend record date. The biggest corporate talking point in Mumbai, however, is the highly anticipated National Stock Exchange IPO. The NSE has officially filed its draft red herring prospectus with SEBI for a massive 30,000 crore rupee public listing. Major state-backed institutions, including the State Bank of India and GIC Re, are set to trim their holdings, offloading substantial stakes in what is poised to be one of the largest capital market events in Indian history, unlocking immense value for early institutional backers. But the NSE's initial public offering filing is not without dramatic controversy. The draft prospectus revealed a highly unusual system glitch where a complete stranger accidentally received 5,000 shares of the exchange. Before the clerical error was detected, this individual managed to sell over 3,600 of those shares on the unlisted market. Meanwhile, the broader primary market is heating up further as Reliance Industries telecom giant Jio Platforms has also initiated its formal filing process for a blockbuster IPO, setting up a clash of the titans. Shifting our focus to global macroeconomics, the United States dollar is riding exceptionally high on the international stage. This strength is driven directly by a newly hawkish stance from the Federal Reserve, with policymakers signaling that interest rates will need to remain higher for longer to permanently cool core sticky inflation. Across the Atlantic, European Central Bank chief economist Philip Lane defended recent rate decisions, hinting that despite global growth concerns, domestic price pressures mean monetary easing will be a slow, highly data-dependent process. Despite these restrictive interest rate structures, equity capital is still finding its way into high-growth assets. Wall Street tracking data shows U.S. stocks drawing record-breaking weekly capital inflows, as global fund managers aggressively pile into dominant technology companies. However, this private markets craze has prompted prominent analysts like Jim Cramer to issue stern warnings to retail investors, advising caution when buying highly illiquid secondary market shares of private giants like Elon Musk's SpaceX at highly inflated private valuations. Geopolitical risk is also creeping back into global asset pricing models. Global equity futures slid lower after high-stakes international nuclear negotiations with Iran hit an early, unexpected snag in Geneva. As diplomatic channels stall, defense analysts are warning of potential retaliatory escalations, forcing energy traders and global logistics networks to price in a higher geopolitical premium, directly impacting multinational manufacturing and corporate trade routes. This diplomatic gridlock is having immediate physical consequences on the high seas. Shipping traffic through the critical Strait of Hormuz has thinned significantly, with major international shipowners erring on the side of safety and diverting fleets around longer routes. Consequently, global oil benchmarks have steadied at elevated levels as energy traders assess the tangible supply disruptions against a backdrop of tepid global manufacturing demand, leaving the energy sector highly sensitive to any further news. In the global trade war arena, the United States Trade Representative has launched a targeted tariff probe into Germany's pharmaceutical drug pricing policies. Washington alleges that Berlin's regulatory structure creates unfair barriers for American biotechnology exporters. This protectionist tension is emerging just as global commodity markets face structural supply-side shifts, with nations like Ghana weighing plans to take local ownership control of major gold mining assets currently held by international mining conglomerates. Turning to corporate movements in Europe, a historic shift has occurred in the Spanish equity market. Banking giant Banco Santander SA has officially surpassed fast fashion powerhouse Inditex SA, the owner of Zara, to become Spain's most valuable listed company. This milestone highlights the massive structural tailwinds that the elevated global interest rate environment has provided to major commercial banking institutions, allowing them to post record-breaking net interest income margins. In summary, we are witnessing a highly interconnected global economy. While India faces localized technology valuation corrections, its underlying macroeconomic growth and blockbuster IPOs like the National Stock Exchange show immense secular strength. Meanwhile, global asset allocators must navigate a hawkish Federal Reserve, geopolitical commodity constraints, and rising trade protectionism. Stay vigilant, manage your portfolio risk, and subscribe for more deep dive financial analysis. We will see you in the next video.